My name is Adam Myers, and I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Ted Franks, the portfolio manager of the Pengana Web Sustainable Impact Fund. Just a brief reminder for those of you who are less familiar with our business. At Pengana, our key aim is to offer differentiated strategies which add value to our clients' portfolios. We have no Me Too funds across our business. And Web's business is entirely focused on sustainable and impact investing. This is the only strategy they run. They have managed this fund since August 2007, when Pengana acquired it through the merger with Hunter Hall. The team are based in London, which is 11 hours behind us, so apologies for the slightly earlier start, but it's already 9:30 in the evening for Ted. During this presentation, if you have any questions, please enter them in the question box and we will get to as many as possible of them at Q&A at the end. Ted, over to you.
Thank you, Adam, and thank you everyone for joining, as Adam says, early in the morning. We've obviously had that thing when our clocks and your clocks go in different directions, so it gets harder to stay in touch, but it's still great that, of course, we can reach you guys by webinar like this. Sorry, I just passed through the disclaimer there, and you can have a look at that in your own time. So this quarter, Q3 of 2021, we're going to talk a little bit. I'm going to talk a little bit about the macroeconomic developments in the quarter, and as a sort of a trailer, this is very much around inflation. This is the key topic of this quarter, and then on to some deeper thoughts about how much of that inflation or why that inflation might be driven by the transition to a sustainable economy, which is what drives the Pengana Web Sustainable Impact Fund and what we're all about as an investment team. And then there are some reflections, and as a spoiler on this, we're not going to talk about COP26 today. COP26 obviously is coming now, so it'll be in the fourth quarter discussion. There's going to be plenty of content coming out from us on that topic, but we do think this provides, the quarter we've just seen provides a really interesting economic backdrop to policymakers as they gather in Glasgow to try and hammer out a way forward around climate change. At the end of the presentation, of course, we'll talk about the performance of the strategy in the quarter and the themes and the companies that drove that performance. And of course, a lot of it is related to the inflation and supply chain issues we're going to talk about. So without further ado, the big macro story in the course was really around inflation. You can see here on the left-hand side, the consumer price indexes in three of the big markets that we invest in, the US, EU, and the UK, rose through the year but remained strong and got to quite high strength in the third quarter. The interesting thing now is that the narrative of high growth and high inflation has somewhat got a bit of a wobble around it. You can see on the right-hand side here the manufacturing purchase managers indexes, which is an indicator of economic confidence, starting to roll over in that third quarter as well. And so now policymakers have potentially a bit more of a challenge coming down the track, because you have this idea of stagflation, this phrase which was sort of coined in the 1980s, where you'd have inflation on one side, but also rising employment on the other side. And that's obviously a very tricky combination for living standards. But markets aren't quite so interested in that. And in the short term, they're more focused right now on the inflationary side of it. And what this quarter did have, which we thought was very marked, was a kind of hinge point around the 21st of September and a meeting of the FOMC, so the Federal Open Markets Committee in the US, which is kind of the highest body of their Federal Reserve, which is their central bank. Until that meeting, the third quarter had been around a reassertion of a kind of lower inflation, low interest rate kind of paradigm, which has been around for a couple of decades, really, or a decade at least, because the first half of this year instead was seeing more of an inflationary environment and seeing value strategies outperform growth strategies. And then after that meeting, we had this very sharp style rotation, which you can see here on the chart. And it's all about this idea that inflation's coming, we're going to need higher interest rates, we're going to need the end of accommodative monetary policy. And that event at the end of the quarter was likened in a lot of places to the so-called taper tantrum, which is going back now 8 years, which seems amazing. It seems it's much more recent than that. Shows, I guess, that I'm getting a bit older. And that was when Ben Bernanke, the chap pictured here, who is the last but one chair of the Federal Reserve, so America's key central banker, made some comments which implied that he was getting ready to take away the accommodative monetary policy which had followed the great financial crisis And that caused a sell-off in US bonds. You can see that as the blue line here, rising up through the early part of 2013, the so-called taper tantrum. Everyone got very upset that he thought that he might take away that accommodative monetary policy. As it happens, it turned out, he didn't actually end up taking it away. So it just became a tantrum, and there was no, in fact, taper. There was no withdrawal of monetary policy. But this is the kind of precursor for how markets interpreted what happened in the third quarter. Now, all of that is a very kind of generic macroeconomic view, and of course relevant for us as investors, and feeds into things like how we think about the valuations of our stocks, and perhaps how the fund is positioned in terms of what's an appealing equity investment at the time, obviously over and above just the company investment. But more interesting, we thought, is just to unpick a little bit of where that inflation is coming from and think about this idea of greenflation. Because it occurs to us that right now, the transition to a sustainable and low carbon economy is really feeding into these inflation phenomena in a very interesting way. And of course, with COP26 happening right now, this is a really interesting time. And the strategy, Adam says, of course, we've been running the fund here since 2017. The strategy does go back in its form here in the UK till 2006. And we've never really seen quite such an interesting time, so I'll come on to in a second. So let's look at some of those components of inflation which are coming from the green transition. Well, first of all, this quarter also saw a fairly clear fossil energy price spike. You can see on the chart here, liquid natural gas prices in Asia, particularly also in the UK, our natural gas prices spiking right up in the quarter. Now, there are proximate causes for that. We are obviously coming out of a COVID situation at different speeds around the world, I should say, but generally emerging from it. So economic growth is growing. There are bottlenecks there. There's competing demands. There's political things going on to a certain extent from some of the countries which supply some of the fossil fuels. Taking a longer term view, what I think is undoubtedly the case is that the investment in fossil energy, quite rightly, has been on the decline. And that's good capital that could be put to use, and would like it to be put to use, in alternative energy sources. But of course, it's very difficult to match the decline of your investment in fossil fuels with the way that the demand side is going to move around. And that's what happened in this quarter. So there isn't enough sort of supply capacity currently active, and the demand was very high. And so the price of fossil energy rose up, and that fed into inflation. Now, we actually like that, because high fossil energy prices, and particularly volatile fossil energy prices, encourage people to look for alternative energy sources which don't suffer the same inherent disadvantages, and of course aren't going to contribute to man-made climate change. But that's one way in which the transition is influencing inflation. Another interesting point that comes out of that, of course, is whether or not that is a simple cause and effect in itself, or whether actually that shortage of fossil energy is a symptom of a larger malaise, which has been captured here on this very memorable Economist front cover, saying the shortage economy. We've seen not just shortages in energy, fossil energy supplies, but also shortages all across the board, from consumables to durables and components as well. And that's part of an unwinding of global supply chains, which proved themselves to be so fragile during the lockdown, and now are really struggling to try and build some kind of resilience. And there's a government policy response happening to this in various places. And there's an infrastructure bill in front of the US Congress now, which has got $100 billion allocated to try and build resilience and onshore critical supplies in the US. But its job is being made more difficult by the very climate change that obviously we're all trying to seek to mitigate. And you can see that if you have these long and sensitive global supply chains, and you're faced with more and more extreme weather and challenging climates, then you're going to have an issue with making that supply secure. And there's been a very good study by McKinsey in the last month, which looked specifically at rare earths and also at semiconductors, and said that actually, as a result of already existing climate change, these supply chains are going to be tighter, there's going to be bottlenecks, and that's going to probably feed through, as we say, into inflation. So there's a second sort of cause or strike in the transition to greener energy, which led to sort of some of the inflationary pressures, which is what we saw so acutely in this last quarter. Now, we see these things, it's worth, in passing, we see these things mostly through an industrial lens. We spend our time dealing with companies and trying to be active owners and obviously doing our stock picking. So there are examples all through the portfolio, but a couple I thought I'd just quickly share with you. Premier in our health theme, that's a group purchasing organization in the US. It's all about reducing prices and securing supply for their healthcare customers for equipments and consumables and drugs. They've got together with 11 of their customers, set up something called Alexa Pharma, which is a platform for providing security of supply for key drugs into the US market. And perhaps even more straightforwardly, on the right-hand side, First Solar, one of our more recent additions to the fund, it's a solar module manufacturer, but it's pretty unique. It's unique for two reasons. Number one, it uses a technology called thin film based on a substance called cadmium telluride, while the rest of the solar market uses polysilicon. Number two, that polysilicon market is really based around China, and First Solar is a Western producer. It's an American company. And they, of course, are being heavily now supported and nurtured really by the US government, which is very keen to make sure it's got an available onshore solar manufacturer to the US utility industry. So these are more examples of a move really in terms of supply chains going from just-in-time efficiency to just-in-case resilience to try and combat some of those inflationary pressures. So if we've seen already that through the spiking fossil fuel prices and through the sort of shortage economy, we've got issues related to climate change driving inflation, there's a more straightforward mechanism, of course, and that's in some commodity prices, the commodities and materials which are needed to make that transition. And all of those prices have been rising as well. We did talk about this briefly in the last quarter's webinar for those that were tuned in then as well. You can see some of the prices here. Obviously, carbon price going up. We need to go up much higher than this, in fact, if we're going to really incentivize the innovations we need to see to decarbonize the world. Pea protein is a key ingredient in a lot of the plant-based meat alternatives, which have become so popular now. We're seeing the price of pea proteins and all other plant-based proteins rise globally. And then lithium carbonate and copper, both of these key ingredients in electrification and in battery storage. Now, both of those are trading within a range which we've already seen them trade in historically. But actually, as time progresses and the transition increases, the share of copper global demand that will come from the transition will increase, and the price of that is likely to go up as well. And all of these processes are happening in a microcosm, or did happen in a microcosm, in the last quarter and just before COP26. Now, the medium term and longer term view on this, though, we think is more interesting, or is better news generally. And this is the cost curve that you'll have seen before for renewable energy and also battery storage, and the very dramatic reductions in costs we've seen over the last decade. And going back to the point about fossil energy, energy is such a large component of inflation overall that if you manage to bring the cost of energy down and have cheap, abundant, clean energy as a result of the transition, then obviously that's going to be a deflationary issue. So it's a deflationary factor. So it's really a question of pushing through this inflationary period and this troubled and challenging moment and getting through to the point at which we can go to a cleaner energy future and inflation not be the challenge that it appears to present at the moment. But that's a key challenge, because we have seen several governments globally somewhat backsliding on addressing this challenge of the transition as a result of the short-term pain it's going to introduce. One more chart before I move on very quickly, by the way, just a sort of hat tip as we go past to hydrogen. This isn't actually historic. This is a forecast curve, which is the one that matters here, the sort of right-hand side of this, coming again from McKinsey, this time working with the Hydrogen Council. And hydrogen is an important technology for some of the higher energy density applications. So hopefully we'll see that same cost curve come down as well. So with all of those inflationary pressures in place and manifest in this quarter, the world's governments are gathering now here in the UK, up in Glasgow, to talk about what we're going to do to effectively enforce or strengthen the Paris Accord at this new meeting, COP26. And it's really interesting, we think, that you've seen these volatile fossil fuel prices feeding into inflation and driving governments to think about security of supply for natural gas. And then it becomes a security issue as well. So you have environmental and security issues together. But the bigger picture overall is that it's now so key for economics mainstream economics, the way that countries think about their growth over the next 2 decades, is really going to be determined around how they handle this transition, all the risks that are involved, the risks including of inflation, and also the opportunities they present. And it's really coming now at COP26 that they'll have a chance to really kind of get to grips with that. And stay tuned to see whether they do or not, which, as I say, we'll report after the event. So that was how we saw sort of the interesting sustainability economic events unfolding in the quarter. How did the fund perform in that period? Well, we tell our fund performance through the attribution of our 9 themes, and you can see them here. The attribution is a mathematical way of calculating the contribution to the overall performance from each of the different themes and also the stocks underneath them. The fund overall had a marginally positive relative performance. This is relative to our benchmark, which is the MSCI World Index of Equities. And the biggest positive contributors were health and environmental services. And the biggest negative ones were safety, cleaner energy, wellbeing, and resource efficiency. We'll come on to those in detail. Before we do, though, worth just highlighting the 4th positive contributor, the thematic selection effect. Those that were tuned in last quarter will know the thematic selection effect is the attribution to the rest of the benchmark, which is not inside our sustainability universe. So that is to say, it really represents whether or not sustainability, as we define it, has been a headwind or a tailwind in the quarter. And up until the end of last quarter, it had been a historic headwind. It's generally been a tailwind through the existence of the strategy, but it had never been such a strong headwind as it was in the last 12 months. So good to see that it reverted in this quarter. But then taking starting with the underperforming themes and linking them back to what we were saying about the big sort of macroeconomic issues in the quarter. Starting with safety, we had a big negative contribution from Intertek in our safety theme. Intertek is a testing, inspection, and certification company. These companies really are the sort of grease in the wheel of global trade. They like supply chains that are functioning effectively. You can see here on the left-hand side, Intertek and its 2 peers, SGS and Bureau Veritas, and the big drop in their organic growth as the world slowed down through the COVID lockdown. Intertek suffered because it hasn't recovered as quickly as the other 2. That's to be expected, really. They have slightly different industrial exposures, and we're not so worried about that. We're more interested, in fact, that actually, even if supply chains are becoming a bit more stretched and there are these issues around shortages, Intertek has a bright future anyway. They'll find things that they can do to service their clients in reorganized supply chains. They also have a big growth opportunity from sustainability itself, and that's providing evidence for companies to back up the claims they're making about the sustainability of their products. They've had this Intertek sustainability product around since 2015, and it's an important part of their growth going forward. The other thing just quickly to mention on Intertek as we go through is that we have had a recent engagement success, which was to get them to commit to a net zero carbon target, which they have done this year following our engagements. That's good news on Intertek. Then moving on to other areas which underperformed, and again, linking them back to this idea of inflationary pressures, the companies named on this slide on the right-hand side are all from our cleaner energy, resource efficiency and sustainable transport themes, more of the industrial companies. And these are the companies and examples where, as you can see, they've had to give margin guidance downgrades. That's because they've not been able to cope with the increase in cost prices during the quarter and pass that on to their customers in terms of price increases. Most of those companies can do it. We tend to invest in companies with good pricing power. It's a very obviously complicated situation at the moment. It's more disrupted than it's been before. And you can see the result of this downgrades and guidance in the share price performance on the left. I think we talked in the previous quarter of some examples of companies which had told a better story, been able to tell a better story. And we had some of those in this quarter as well, just to provide balance. Some of our companies which are more in the electronic supply chain, such as Infineon, which is a big maker of components for electric vehicles, Littelfuse, which makes electronic safety components, which fits in our safety theme and feeds into all kinds of different electronification applications, and TE Connectivity, which is also in our sustainable transport theme, and again is feeding into the EVs, but does have other industrial applications as well. All of these companies had gone into allocation situations where they're trying to decide which of their customers' orders to satisfy, and they are able to pass on any additional costs and really keep their businesses ticking over quite nicely through the shortages. So then moving away, blessedly maybe, because we've been talking about it for a long time, from inflationary issues and just moving on to some of the positive contributors in the third quarter. We had good performance from the health theme, as you've seen. Three of our key names in that space, the life sciences tools companies, Thermo Fisher, Danaher, and Agilent, three names we've owned for over a decade in the strategy. They are all now have grown into really significant organizations and really kind of dominate this space. They've had a wonderful boost, as you can see from the chart, in their organic growth, particularly around the work they do in life sciences, so helping companies discover drugs, and also in diagnostics. Obviously, there's a big call for diagnostics as a result of the pandemic. The interesting thing about these names and what came through in this quarter was, whilst everyone had expected the organic growth rates to come off after the sort of depth of the COVID lockdown, they remained relatively high. But more importantly, these companies have taken this opportunity to really increase their strength, and they've broadened and deepened their relationships with their customers. They've been able to reinvest this bonus cash effectively they've been given into new technologies, and they really have taken a lot of market share from some of the smaller competitors. So on the right-hand side here, you can see Thermo Fisher, which is now a very significantly sized company, taking its sales growth forecasts up from 6% to 8%, which is quite a high number. And you can see Danaher on the left side doing something pretty similar. And Danaher also has been very fortunate, but very foresight, I guess, with good foresight. Just before the lockdown, it bought GE Healthcare, which is rebranded as Cytiva. Cytiva's got this wonderful leading position in biosimilar and biological drug manufacturing. And that's turned out to be a huge growth engine for that company as well. So these guys continue to be very well positioned. Staying within the health theme, we've got ICON. So ICON is a contract research organization which we've been invested in for a couple of years now. Contract research organizations help drug companies run the trials they need to test and develop their drugs. Doing that more efficiently and safer, obviously, is a big part of making drugs more available to wider groups of patients at a more affordable cost. They are a very well-run company. At the end of last year, they set off on a merger with a biggish rival called PRA Health Sciences. The market was unsure about the price they'd paid and generally skeptical about performances of mergers in the CRO industry. We like this merger. PRA in particular has got something inside it called Symphony, which is a data platform for analyzing results from other drug trials and helping to help with things like patient recruitment and drug and trial design. And so that's a very powerful piece of capability, which was missing from ICON's portfolio. We knew they'd have to add that at some point. We weren't sure how they'd do it. We think this deal is probably a good way for them to have done it. And the market in the third quarter, somewhat belatedly, starts to agree with us. And then lastly, from me today, before the questions, we saw environmental services have been a good theme for us. One of the key names in that space in this quarter was DSM, a Dutch company we've been invested in since 2017. We're huge fans of DSM. It's a mission-led company, really built around sustainability. It's a chemicals company. It's got a strong tradition of innovation, coming up with new and exciting ways to solve sustainability challenges. One of the reasons we invested in 2017 is that we perceived they were, as well as really focusing on sustainability, they were going through a very sensible portfolio reorganization process. And this has probably reached its kind of ultimate destination in this quarter when they've announced that one of their two key business divisions, they have a nutrition division and a materials division. The materials division is now under strategic review, so they'll be just a nutrition business. They've got all kinds of interesting products in the nutrition space around decarbonizing existing food value chains, but also supporting the new plant-based ecosystems as well. And so we're very keen on that. It's going to be a much growthier company as a result, and we think that's a really good transition they've made. In passing, it's worth saying too that these guys are absolutely leaders in their sustainability approach. They have also in the last quarter increased the ambition of their net zero carbon pledge. They're now looking at cutting their 2016 baseline emissions levels by 50%, as opposed to the previous 30% by 2030. That's a science-based target that they've developed with the Science Based Targets Initiative, and that's also the gold standard for companies. So really a lot of what DSM does in sustainability is pretty much gold standard, we think. And that's why we like this company so much. Okay, so thank you for listening to me talk. I'll now leave with, there's our performance over the history of the track, of the full track record of the fund strategy, and I will go to questions.
Great, thanks, Ted. That was very comprehensive. Why don't you have a quick glass of water while I get to the first question?
It's late.
We received a number of questions that seem to be primarily focused around two themes. The first is COP26, which I know you said you weren't going to discuss extensively, and the second is inflation. So without straying too far into La La Land, what are you hoping will be achieved in Glasgow, and realistically, what are your expectations?
Oh, wow. I mean, obviously, you would hope for a meaningful, any economist who works in sustainability has always wanted a carbon price, a meaningful global carbon price. So that's the sort of potentially La La Land. I mean, it seems a million miles away, but some kind of mechanism around unifying the existing carbon price markets and encouraging more countries to join them, that would be the single most powerful thing that could happen. Obviously, the critical point in COP26 is to try and get some of these NDCs, these national plans the countries are making, to make them more aggressive and try and unify around higher and more aggressive targets, so we can get below the 1.5 degrees of heating. And at the moment, we're sort of well above that. So that would be the sort of second, perhaps overly ambitious. Realistically, I'm afraid I will be pleased if it's more than just a series of smaller pledges and platforms around some of the subsidiary issues, admittedly, though, which we know are very important. And those would be things like methane, aviation, deforestation, shipping, and I guess kind of critically Article 6, so-called, which is about the carbon offsets mechanism. So I think it's not ridiculous that we'd get something there. We'd hope to get something there. If we don't even get a decent slew of those sort of commitments, then we really aren't doing particularly well at all. So let's see. But I mean, that's obviously, we'll wait and report when it comes out.
Right, makes sense. You've said that the energy transition will be inflationary. How long do you expect that to last?
Yeah, I mean, that's a good question, isn't it? Because deflation has been so powerful for the last 2 decades, driven by globalization and also by technology. And of course, expectations are a big part of inflation too. So actually, the world's got this habit of expecting a deflationary environment. So how long will this burst that I've described in so much detail sort of go on for? I mean, I guess if taking something of a free shot, I guess you'd expect there to be somewhere between 2 to 5 years of it. Hopefully, the shorter element of that, and whether or not it's enough to actually overcome the deflationary pressures, which I expect to reassert themselves a bit once we get properly clear of COVID, to the extent that we get properly clear of lockdowns and get to something resembling a kind of more normalized economy, is the key question. Whether we do just get, because if it's longer than that, then we have got a sort of really significant challenge, and then the political will to drive this thing through will be more difficult to achieve.
Great. And continuing with the inflation theme, inflation resilience is often associated with the pricing power of the investee companies. How would you rate the pricing power across your portfolio as a whole, and are there any standouts?
So we tend to look for companies with pretty good pricing power if we can. We have a quality bias to how we invest, which comes really from wanting to invest in these companies for the longer term. And you can look at that from a financial point of view and look at their cash flow return on invested capital. And they tend to be, across the portfolio, higher cash flow return on invested capital companies. And that speaks to them having the ability to keep their prices moving above their cost base over time. And in fact, actually, quick plug, one of our annual investor conferences a few years ago, I did talk in more detail about pricing power. Generally, that having been said, and sorry if this is a long answer, there are sectors that we would like to invest in which aren't necessarily defined by pricing power. So we have investments in Hikma, which is a generics company. That's not a pricing power market. Kind of anything which is in the automotive market, even if you're providing EV components, that's a market which traditionally has a price decline every year. So pricing power there is much more subtle. The real standouts, I guess, answering your question directly, some of our industrial companies, actually, if you look at them, and I know A.O. Smith appeared on the slide this time, but A.O. Smith's got a remarkable record of being able to put price rises through. Lennox Industries has as well. Lennox International has as well. So those are the sorts of names where you'd really see quite striking sort of pricing power.
Thank you. Continuing with the energy theme, how does fossil fuel energy dollar per kilowatt compare in terms of trend and in absolute terms relative to renewables?
So the way to look at this is an analysis which lots of people do, although we haven't done it ourselves, but that's the levelized cost of electricity calculation. Of course, there's lots of assumptions that go into that, because what you're trying to do there is take the original capital cost and amortize that across the period that you're generating energy from, and try and make some assumptions about, okay, if you have a gas plant, how long is it going to last, and what's its load factor going to be, how often it's going to be operating. On a sort of straight race basis across the life of the assets per unit of electricity generated, then solar and wind are already the cheapest to generate. If you then balance that with the requirement for load balancing, then depending on the assumptions you can make, then you can have places in the world where natural gas would be equivalent if you're giving the right kind of balancing factor there. And of course, you've got to be able to run it as part of a grid, which has a sort of portfolio context in it as well. But the headline is that actually the two big renewable technologies are already really the cheapest sources of energy. The question is designing that grid around them to make sure you've got the resilience that you need. I hope that answer was helpful. So it's LCOE. I mean, we would most often look at Bloomberg New Energy Finance, but lots of people do run that calculation. We don't do it ourselves.
Perfect. And on the subject of the grid, are you guys looking at grid-scale battery solution providers?
We would certainly, but we aren't at the moment, because none of them are big enough, listed, have proven enough track records for us. We are generally investors who like to see a business model that's proven out, and these companies are much before that. We don't always have to be it's not that we always need to see that being the case, but it needs to be a pretty exceptional company for us to do that. And actually then you need to have valuation that makes sense as well. And none of these companies around battery storage are really ticking both of those boxes at the same time. So we're alert to it and watching for it, but it's not really in our space yet. They're more speculative and they're smaller in their earlier stage.
Understood. Two quick questions about DSM. Firstly, what exactly does a strategic review of their materials division mean? And secondly, on the right-hand side of the chart, there was reference to carbon credits and a dollar value attached. Can you please explain that?
Strategic review, sorry, I should be clear. I've got to be a bit careful. I mean, they will call it a strategic review. It's for sale. That's what it means. It's banker speak for it being for sale. Although again, presumably if they were to find this, they'd say no, it's a strategic review. No, you have to cover yourself in case you don't sell it. The dollar value of carbon credits, the images were taken from the website. Now I'll have to just double check this. Hold on, let me just scroll back a couple. What must they be referring to here? Do you mean the internal price of carbon, the grey? If it's the grey circle, then better companies are doing this now, which is great. You have an internal mechanism where you're pricing the carbon produced. And when you're doing your NPV for your capital allocation inside the company, then that number is feeding into your decision making to allow you to favor the solutions which are less carbon intensive. Obviously it's a sensible construct because it guides you to lower carbon initiatives. it's also kind of predicated on the idea that at some point that carbon price will be real. But it's just a very useful, I mean, this is to my point about wanting a carbon price. This is what you'd want companies to actually be doing, is when they lay out their forecast cash flows from every investment opportunity, they'd have a carbon price in there, which would be guiding them to the low carbon products. I hope that was the question that was being asked.
It was, because the person who asked has just confirmed that that is what he wanted to understand. The next question is, are there any geographical markets that you are seeing disproportionately more opportunities emerging in?
So in the history of the strategy, Europe has, okay, so a developed market strategy is the first point. Our only potential emerging market exposure would be through our Asia Pac sort of sleeve. We could do Hong Kong listed Chinese companies. There are all kinds of questions there which we can go into, but we're not particularly hot on China at the moment. Traditionally, Europe has been stronger on impact and ESG companies, and so the universe is slightly overweight towards Europe, and they tend to tell a better long-term story about why they're being driven by sustainability. What has certainly happened now is the US has warmed to this enormously, particularly with the listing process of these SPAC, special purpose acquisition companies. Quite a lot of interesting looking sustainability story companies have come to market in the last year and a half. Most of those have been grossly overvalued and have been companies that have struggled to raise finance in other places before they had a SPAC. And so, you know, picking the right companies that have come in through SPACs is quite a thing, and we tend to be fairly skeptical about it. But that's definitely where the flowering of new interesting companies that we couldn't have access before is at the moment. This is kind of, in the best case, it's kind of a flowering of US venture capital, whether it's Silicon Valley or in the industrial complex, these interesting companies coming up and now being available in the public markets. That's definitely of interest to us and will be over the longer term.
That makes sense. In the interest of time, I'm going to wind things up at this point. If your question wasn't answered, we will respond to you directly. I guess my key takeaway from today was, although there is a great deal of uncertainty around supply shortages, inflationary pressures, monetary policy, all those sorts of things at the moment, over the medium term, the renewable economy provides very viable solutions to many of those challenges. Our next webinar in the series is next Tuesday with the team from Axiom, who will be explaining their approach to identifying and investing in dynamically growing businesses globally. For those of you who haven't yet registered, I urge you to do so on our website. Thank you very much for joining us today. If you have any other questions, please get in touch. We'd love to hear from you. And if you are placing any bets on the horses, I wish you the best of luck. Have a good day.
Thanks, everyone. Bye.